Awesome. Welcome. This is Grace Fellow with You Deserve Grace, the personal financial platform dedicated to helping you find your rich, as well as defining your personal financial goals, whether you're married or single. So today I want to talk about the fact that we live in Canada. But the US is a significant market right beside us. And so, whether you're watching the news at night or you're reading about financial literacy, it always seems to be you need to understand the US before you can even start to understand Canada, because a lot of the information we get are from US based experts, and really hard to find Canadian based stuff. And so we're going to talk about the terms when you're hearing them, if you're listening to other financial advisors online, when they're talking to you using US based terms and how they correspond to Canadian terms. All right. So the first one, 401k, most popular, very common. So if you've got a pension at work, that's the closest to your defined contribution benefit plan. So that's where you put in money, and your employer matches it. It's defined contribution, meaning your pension amount is going to be basically what you put in and what your employer puts in. You're not guaranteed a benefit amount that you'll get, but this is the money that will be used to support you in your retirement. So in the US, with the 401k, you can start withdrawing from it at the age of 59. And so in Canada, we have, I think the equivalent would be your defined contribution plan. So every employer will match or not match. Well, they have to match. So this one's an employer match. Your employer is the one who sets this up for you. You don't have a choice. You just have a choice on whether you contribute the max so that you can get the whole employer match or not. Then it's also close to a group RSP as well, because a lot of Canadian companies no longer have a pension, they have an RSP. And so with the group RSP, again, the only biggest difference is that it's restricted withdrawals is the difference with the 401k. So you are restricted on the types of withdrawals you could do. It's most are hardship withdrawals is what you're really allowed to do. And you could do that in Canada too with a locked in retirement account, and with your RSPs. It's tax deferred. That's the biggest thing when they're talking about it. So when you hear a lot of financial gurus talking about, max your 401k, it's because it reduces your taxable income the day you put it in, just like an RSP, but it does increase. You do pay the taxes out on the end when you do take it out. And then with the 401k versus an RSP, there's actually a penalty. They charge you for taking out the money before the age of 59. Here in Canada, regardless of whether you take out your RSP money, you're always going to have to pay withholding tax. And then that withholding tax is just used to offset how much your total tax is going to be, when you do turn around and take out that money. It's taxable income because it wasn't taxed at the beginning. So that's the 401k. So biggest thing, only the employer can open it, and it's only valid with an employer. And just like your pension here, you can move your pension from one employer to the next as long as their pension plans are, within the same jurisdiction and the rules. So for example, if you work at a bank, you're federal jurisdiction, and maybe move over to a credit union, which is provincial jurisdiction, those pensions don't necessarily match, because the rules are different between the two. There's some that do match, and it's up to your pension administrator at the new job to tell you, yes, you can roll over your pension. So that's what it means when people talk about rolling over the 401k into an employer, like to a new employer, or just taking it out, and having it under your own control as a locked in retirement account. CDs, this one's pretty common. It just means GIC. It's a certificate of deposit. So when you are taking money in and putting it into the bank as cash, guaranteed, depending on the issuer, but usually guaranteed. That's what a certificate of deposit is. So a CD, a GIC, same thing. So CD, certificate of deposit. Canada, we call it a guaranteed investment certificate. So same idea. They're not market-based products. They are just, cash, in an account, with a guaranteed savings return, and guaranteed principal. I should say guaranteed principal is the biggest thing, because you can buy some CDs or GICs that are market based where the rate of return is based on how well the market does. And rate of return, I just used another one. So rate of return just means how much you can expect to earn on your investments. And so that's most times not guaranteed, but in a GIC, that's not market based or market linked, I should say, it will be guaranteed. So that's the only investment where somebody can tell you this is what you're guaranteed to get. An IRA, so individual retirement account, is what they call them in the US. So you can set up your own. Again, it's tax, what is it? Tax deferred. So it's income that hasn't been taxed. You put it in there, you get a tax deduction you can use on your taxes to reduce your income. But when you take it out, you're fully taxed on the amount once you take it out. The difference with an IRA and a 401k is your limit annually is a little bit lower than what your 401k is. And you can also choose how you want. Same with the 401k, though. You can choose how you invest it. The company just has, usually they're using an administrator, and so you kind of have to go with whoever it is. So here in Canada, you'll usually have like Manulife or Sun Life or whoever else, maybe your pension administrator. They will show you what investments you could do in your 401k, whereas with an IRA, just like your RSP, you choose your brokerage, you choose how that money is invested, and you choose how much you put in every year. But just like RSPs, again, they're meant to be used when you are retired. The biggest difference here is there's no real restrictions, I guess, in terms of how you take it out. You will still have the withholding tax applied. So, and again, tax deferring is the biggest thing. Roth IRA, that's the closest to what we have here in Canada with the tax free savings account. So, in the States, the biggest difference is the employer can actually contribute to your Roth IRA. You can have an employer match in that, which is kind of cool. But it's after tax income, right? So it's, bottom line if we're talking from an accounting perspective. So it's after all your other deductions have come out, and then it goes in there. So it grows tax free. And so that one cool difference is in Canada, you can borrow against, so you can create collateral using your tax free savings account. Whereas in the States, you can create collateral on your 401k. So you can actually borrow against your group RSP or your defined pension and that kind of thing. And in Canada, those accounts cannot be collateralized. They cannot be, they're creditor proof basically. Um, and what else was there? Oh yeah, the 529. That's your RESP. So education savings. The other one that they have within the 529 in the US is you can actually choose your university that you want your kids to go to and actually start prepaying tuition directly. That's kind of cool. And it's also still the same idea where it's after tax money, but it's tax deferred growth. And when you do take it out, then it becomes taxable, but ideally taxable to the child. So same idea there. 1031 exchange, that's where you sell a property or an investment that has significant capital gains, and you're able to take that money that you earn from that investment and roll it over to a new investment. That exists as well here in Canada. It's just a capital gains deferral. It's a little bit more restricted. You'll have to check with the CRA when you're ready to do the transaction because they keep changing what's eligible and what's not eligible for capital gains deferrals. And so, as long as the idea is that you're investing, so you're moving one investment from another. So the earnings from that investment, you're moving them to another investment. There's a time frame here in Canada in terms of how soon you have to do that. You have to declare that capital gains deferral, as it looks like in the States with a 1031 exchange. You've got a bit more time. You do have to declare it, but in terms of how soon you use that money, that's the biggest difference between the US and Canada. So, yeah, lots of differences. So keep that in mind if you're ever listening to US based financial advice, that there is a significant difference in what they can and cannot do with different strategies. And so you always want to make sure you're looking for Canadian based advice, which is what we're offering here at deservegrace.com or my handle at deservegrace. Thanks for listening. Take care.